A no-good, horrible day turned into a no-good, horrible earnings for this chip equipment provider. Momentum for accelerating growth had been building throughout 2025. We are on the verge of an AI-backed upcycle where revenues are set to explode. That is the thesis, anyways, for Applied Materials, a vital business in the chip ecosystem. Applied Materials is at the forefront of developing the tools necessary for AI to even exist. So, why were their earnings so bad? Welcome to The Quality Investor. If you have any investments in the chip industry, except for maybe Nvidia or Broadcom, then you know what kind of volatility you're in for. Investing in this industry requires a solid thesis and strong conviction when things turn sour. And it seems Applied Materials is stuck on sour. My thesis for Applied Materials is pretty straightforward. They are an inseparable part of the AI supply chain and a direct beneficiary of the AI capex boom. To add a bit more color to that thesis, Applied Materials is number one in wafer fab equipment, or WFE, and are the leader in a key sub-technology in chip manufacturing called deposition. WFE is the specialized machinery used to create intricate circuits on silicon wafers. Deposition is the process for adding thin films of material onto a wafer's surface to give it specific electrical properties or to create insulating layers. Applied Materials provides other equipment and is considered a generalist in the chip equipment space and is very strong in dynamic random access memory, or DRAM, which is crucial for high-performance computing and is essential for the workloads AI requires. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. AMAT could be considered a brother to Lam Research, LRCX. I did a video on Lam Research a couple of weeks ago. Please click on that thumbnail at the end of this video. So this is a continuation of the semiconductor industry deep dive through earnings releases. Please check out that playlist also. I say they are brothers because Applied Materials leads in machines for deposition. Think adding layered materials to the silicon wafer. And Lam Research leads in machines for etching. Think sculpting those depositioned materials into the complex patterns that form the integrated circuit. To put this all together from an extremely high-level perspective, I've focused most of my chip ecosystem earnings videos on the equipment side. I also discussed ASML. When it comes to chip manufacturing, Applied Materials, ASML, and Lam Research all serve important functions. Applied Materials specializes in tools for deposition, adding the materials onto the wafer to be etched. ASML specializes in tools for lithography, using light to create the circuit pattern for the wafer's materials. And Lam Research specializes in tools for etching, actually etching the pattern into the wafer's material. I said earlier that momentum had been building for Applied Materials. The earnings we are discussing today are their fiscal year 2025 Q4 earnings, but after their Q3 earnings, they had seen year-to-date revenue at that point grow by 8% year over year, indicating reemergence from the chip cycle trough and signaling strength, despite tariff and other macroeconomic uncertainty. They had even shown success in revamping their geographic mix away from China, where U.S. export restrictions loom, to areas such as Taiwan and Korea, the centers for the most advanced chip fabs on Earth. But that didn't just flatten in this quarter, but seemed to reverse. We'll look at the numbers more closely in a second, but investors balked at a fall in sales to China, down 8% year over year, further highlighting the toll export restrictions are having. For the full year, revenues from the Chinese market are down a hefty 15.7%. This prompted a huge sell-off at the market's opening bell, which saw Applied Materials open down a jaw-dropping 8.6%. Remarkably, the stock has recovered and is slightly down from the previous close. The negative sentiment is also driven by disappointment in the expected chip cycle recovery and softness in overall demand for the DRAM and logic chips. The market was expecting a faster ramp up given the AI capex spending. This has actually led to the premium valuations we've seen in 2025 for the chip equipment providers. Applied Materials has been trading at well above their 5 and 10-year PE average, so any deceleration or even contraction like we see in this quarter will send the stock tumbling downwards. But as I always stress, we are in this for the long term, and Applied Materials is indispensable to the chip supply chain, as I've already demonstrated. On the earnings call, the CEO, Gary Dickerson, emphasized AI leadership, and I quote, "As AI adoption drives substantial investment in advanced semiconductors and wafer fab equipment, we are well positioned at the highest value technology inflections, enabling us to extend our leadership in leading edge logic, DRAM, and advanced packaging." End quote. Turning to the income statement, revenue was down 3% year over year to $6.8 billion. This is attributable to the reduced contribution from the Chinese, which I mentioned earlier. Despite this, full year fiscal year 2025 sales were up 4.4% over the prior year to $28.4 billion. Now, this is actually acceleration from fiscal year 2024, which only saw 2.5% revenue growth. We would have liked to see 2025 close out stronger, but Applied Materials framed this as a mid-cycle pause, with AI as the expected tailwind for acceleration in the back half of 2026. On a more positive note, we see gross margin expansion, up 70 basis points to 48% for Q4 and up 120 basis points to 48.7% for the full year. This was due to a favorable product mix. When we look at the operating margin, it is basically flat on a full year basis, up slightly to 29.2% versus 28.9%. However, we see quite a bit of contraction for the quarter, a steep 380 basis point decline to 25.2% from 29%. 270 of those basis points is due to the restructuring, or basically layoffs. These layoffs were announced in October and reflect some of the issues Applied Materials is having with China. This is something to keep an eye on moving forward, as Chinese export restrictions are expected to affect 2026 revenues as well. What we'll want to pay attention to is that geographic mix. Can Applied Materials continue to up its sales to Taiwan and Korea, becoming even less dependent on China? For the quarter, Applied Materials generated operating cash flows of $2.8 billion, an increase of 9.8%, finally getting back to strong growth here as they struggled the rest of 2025. For the year, operating cash was down 8.3%, mostly due to increased working capital needs and removing paper gains from the equation. We have to subtract gains on investments, the $792 million loss here, from net income because there is no cash transaction involved. This reduction in operating cash on the year and much higher capex spend of $2.26 billion, a year-over-year increase of 90%, resulted in free cash flow of $5.7 billion. This is a steep 24% drop from the prior year. The capex is in service to their new EPIC Center, a flagship facility designed for process and equipment innovation. They are also increasing supply chain capacity in anticipation of higher demand from AI-enabled growth. So, with all of this concerning contraction and delays in the supposed AI supercycle, what does our valuation summary tell us is a reasonable price for this high-quality business? Let's find out. Applied Materials is at $225.39 right now, actually almost up 1% today. And that's a very good recovery since they opened down to $203.75 to begin the day. Has since just been climbing the rest of the day. I said they had a horrible day yesterday, and you can see that reflected here on November 13th. They declined about 4% yesterday before earnings today, where they did open down and then have climbed since then. Year to date, they're up 37.73%. A lot of that is because of that premium valuation semiconductor equipment businesses have received due to the expected AI supercycle. These businesses, ASML, Lam Research, KLA, they're all going to be beneficiaries of the AI capex spending that the hyperscalers are doing. Applied Materials, of course, also going to be a beneficiary of that. The market is expecting some serious revenue growth beginning in 2026 for the next couple of years after that. And that is why we're seeing that premium. You can see down here, they have a PE ratio right now just under 26. If we look at Applied Materials' 5-year CAGR for their revenue, we see that Semiconductor Systems is up 11.7%, Applied Global Services up 8.4%, and their much smaller corporate and other, which they just folded their display segment into this corporate and other segment, down 6.7% on a 5-year basis. I am expecting much slower growth, even with this AI supercycle coming. So my bear growth rate for the Semiconductor Systems segment is at 5.4% up to 7.4% for the bull case. Applied Global Services is at 4.8% up to 9.8% for the bull case, leading to total revenue growth here of 4.86% on the bear, up to 7.7% for the bull case. Right now, really not factoring in a lot of the AI growth that we're expecting to see in the Semiconductor Systems segment, primarily because we just haven't seen it yet come to fruition. I want to see what it's going to look like in 2026, and then what sort of expectations the company guides towards for 2027 before I really up these numbers here. But right now, I'm trying to be very conservative because we just don't know what that's going to look like. For the next fiscal year, 2026, I'm actually only expecting 3.41%. Part of that's based on their very poor guidance for Q1 of 2026, where they're actually estimating up to a 4% loss year over year for revenue, about $6.8 billion at the midpoint. So this contraction might continue through the first part of 2026. Despite that, their operating margin remains strong. It is down a little bit in Q4 because of that restructuring. That's really a one-time event here. Hopefully we won't see it happen again in 2026. But by year 10, I'm expecting an operating margin of 30% for the bear case, up to 34% for the bull case. Free cash flow margins at 20.1% currently. I'm expecting 20.9% on the bear case, up to 25.8% on the bull case there. Their free cash flow conversion is down a little bit this past trailing 12 to 81 cents of every dollar of net income turning into free cash flow. And that is due to the elevated capex that we're seeing here in 2025. It might remain elevated next year as well, but they should normalize thereafter. So I am expecting that free cash flow conversion to be 88 cents on the bear case, up to 93 cents on the bull case. Right now, we're looking at a share price of $225.10. A bit of a surprise given where they were post earnings. But again, that's that 25.9 PE ratio I was talking about. And as you can see, well above their 5 and 10-year average. Their 5-year average being at 17.1 and their 10-year at 16.7. Their forward PE is at 25, which is also far above their 5 and 10-year average. So there's definitely a premium being given right now in the market to semiconductor equipment providers. You'll see a little bit more of that in a second. So based on this current share price, if we did a reverse DCF, the market is expecting 8.3% free cash flow growth over the next 10 years, whereas I'm expecting 7.7% in my base case. So my bear DCF price right now is $178.02, my base case at $215.36, and my bull is at $265.88. Applied Materials pays a very nice dividend. It's projected to be $1.96 for 2026, and I have that growth going at 13% for the bear case, up to 16% for the bull case, which leads to a bear dividend discount price of $225.44, up to $330.32 for the bull case. I keep mentioning that premium we're getting in the market. The exit multiple is at $312.13. That is based on comps of ASML, Lam Research, KLAC, and Teradyne, all of which have a median PE ratio right now of 35. And that's why we have such a high exit multiple, much higher than what Applied Materials is trading at right now. So in my view, that's kind of boosting the valuation here a little bit. Without any margin of safety, there's a buy price right now of $255.87. With a 20% margin of safety, it's a buy price of $204.69. I am even thinking more of a 30% margin of safety, given how much they're getting boosted right now by the premium valuation. That's $179.11 with a forward P of 19.9. Right now, Applied Materials is the fourth largest position in my own portfolio. And if I wanted to add more, which I might actually want to, I'd probably wait for it to come down to about $190, right in the middle of that 20 to 30% margin of safety. I think they're getting boosted a little bit in the valuation by the premium the other comps are getting. And I just want to see a little bit more out of Applied Materials in terms of growth with their revenue. I want to see some of this AI expectations actually come to be. I do think it's a great business. I have no plans on selling what I own right now. But like I said, I want to see a little bit more from them. They're growing their margins, which is a positive, but they're not growing that revenue. We want to see some more revenue growth. And they have that much higher capex spend, but their trailing 12 ROIC, and that is based on a little bit lower net income in 2025, it's at 29%. And while that's below their 5 and 10-year average, Applied Materials has proven to be a capable capital allocator. So we should see the ROIC tick back up once the current capex cycle ends and we see those investments come to fruition.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.